Welcome to the deep dive. Today we're initiating a necessary intellectual demolition.
Demolition. I like that.
We're taking a wrecking ball to this.
Yeah.
This deeply ingrained cultural idea that successful financial management is all about math. Algorithms or having some crazy high IQ score.
Right. The spreadsheet model of success.
Exactly. If you think optimizing your spreadsheets is the key to riches, you should, well, prepare to have your assumptions shaken. Because the sources we pulled together for this deep dive, and we're leaning heavily on the concepts and the psychology of money, they make one thing just emphatically clear.
And what's that?
Traditional finance, it obsesses over data. But real-world financial success, it's fundamentally a behavioral sport.
It is. It's not a hard science. It's a soft skill.
It's about the intricate ways our deepest emotions, our unique personal histories, and the constant social influences all around us. They define every single choice we make with money.
That's the core thesis we really have to embrace. Our mission today is to step outside the world of interest rates and balance sheets to understand precisely why psychology, well, it fundamentally and consistently trumps mathematics when it comes to your own money.
So we're trying to understand the psychological levers.
Exactly, and apply them to real life. Because the single biggest, most controllable financial advantage you have, it isn't hidden in some quarterly earnings report. It's hidden in your ability to manage yourself.
Okay, let's unpack this immediately. I want to start with the central confusion that trips up most people. And that's the profound contrast between being rich and being wealthy.
Yes. Society constantly, almost maliciously, confuses these two terms.
And that confusion is the root of so much poor behavior, isn't it?
It's the starting point for basically every conversation about money. To be rich is, generally speaking, about current visible income or easily observable assets.
It's the showy.
It's the showy spending, the exotic vacation photos you see on Instagram, the luxury penthouse, the brand new Tesla. They're temporary symbols. They're designed to signal status.
But wealthy, that's something else entirely.
It's a totally different beast. Wealth is the silent accumulation. It is savings, it's investments and assets that have been protected and nurtured over time. As our source material beautifully puts it, wealth is hidden.
It's the income you don't spend.
Precisely. It's the vast optionality and flexibility you've built up. It's the security of knowing you could take a year off work if you needed to. It is, by definition, what you don't see.
And to demonstrate why this behavior trumps income, we have to start with this comparison. It's between two men. On one side, you have the ultimate behavioral success story, a guy named Ronald Reed.
And on the other, a story of, well, highly educated, high-income financial failure, Richard Fiscone.
So tell us about Ronald Reed. His story is just fantastic.
It's amazing because it completely shatters the myth that you need specialized knowledge or a huge salary to succeed financially. Reed worked as a janitor and a gas station attendant in Vermont his entire life.
His whole life?
Yeah. He drove a 1992 Toyota Yaris until he died. By all visible metrics, he was just an ordinary man living a very, very modest life.
And yet, when he passed away in 2014, he was 92 years old, and his estate totaled over $8 million.
$8 million, much of which he bequeathed to the local hospital and the library.
So how do you do it? It obviously wasn't a huge salary.
No. His financial success wasn't due to luck or brilliant market timing or high pay. He achieved that fortune entirely through behavior. He was a consistent saver. He invested primarily in simple blue-chip stocks, and crucially, he stayed invested for nearly a century.
He just let time do the work.
He let time and compounding, the two quietest forces in finance, work completely uninterrupted.
Okay, now contrast that with Richard Fiscone.
Richard Fiscone is the polar opposite. He was highly educated, a Harvard-trained Merrill Lynch executive.
So he knew the system inside out.
He was the system. He was earning millions of dollars a year, owned a massive 18,000 square foot home.
Yeah.
He lived that visible, rich life we were talking about.
Then what happened?
Well, when the 2008 financial crisis hit, Fiscone, despite all his deep industry knowledge, was financially decimated, wiped out. He had leveraged his assets very heavily, his spending reflected his massive income, and he lacked the most important thing Ronald Reed possessed: a margin of safety and the ability to endure.
So he had the intelligence, the income, but not the behavior.
Exactly. His need for visible consumption, the overconfidence, the lack of frugality, that all led to financial ruin.
That comparison. I mean, that's the thesis of this entire deep dive right there.
It is.
Reed's success was determined by consistency, savings, and longevity, just pure behavior, while Fiscone's failure was determined by ego and impatience, despite all his credentials.
It just proves what you do with your money, your emotional and behavioral choices, matters infinitely more than how much you earn or how smart you think you are.
And that leads us to a grounding philosophy that we need for this whole discussion.
Yes, the acceptance that no one is crazy. We have to stop looking at the financial decisions of other people and thinking they're fundamentally stupid or irrational.
Because they make sense to them.
They make perfect sense within their own context. When someone makes a choice that seems completely wrong to you, they are, in fact, justifying it by taking the information available to them and plugging it into their own unique mental model of how the world works.
And that model is defined entirely by their life experiences.
Completely.
That is such a necessary shift because it moves us away from judging right and wrong and toward understanding context and background. We absolutely need that empathetic lens before we can analyze the actual mechanics of behavior.
I do.
So let's dive deeper into that subjectivity because the academic world, it loves to pretend that finance should be this cold, objective, mathematical thing.
Like physics.
Right. But our sources argue that finance is deeply, deeply personal. If you and I were handed the exact same spreadsheet of market data with identical potential investments, we could look at the same risk level and make two wildly different decisions. Why is that?
It's the subjective influence of personal history. Money management is not a hard science. It's a soft science, and it's deeply shaped by what economic environments we grew up in. That fundamentally anchors our perception of risk tolerance and opportunity.
Can you give us an example? How does that generational context matter so profoundly?
Sure. Let's look at inflation. Our sources point out that people who grew up during periods of high inflation, say in the 1970s, they tend to invest far less in conservative assets like bonds, even today.
Compared to people who grew up with low inflation.
Exactly. Compared to those who experienced low inflation their entire lives. And the reason is, well, the memory of watching your purchasing power just dissolve because of runaway prices acts as a permanent emotional scar on your financial model.
So they see cash and bonds as inherently risky.
Inherently unstable, yes.
And the challenge is, you can read every book on monetary policy, but you can't truly feel that fear, can you?
You can't. No amount of studying or open-mindedness can genuinely recreate the gut-wrenching power of fear and uncertainty from past economic events. I mean, if you lived through the Great Depression or persistent hyperinflation,
Or even just 2008.
or even 2008, if you were laid off then and you lost half your retirement, that experience isn't just a data point on a chart, it's an emotional anchor. Your perceived level of risk isn't rationally calculated based on current Fed data. It's reasonably weighted based on your history of pain.
Let's pull out an example that seems, on the surface, purely irrational. The lottery ticket.
Yes.
From a cold mathematical standpoint, spending money on lottery tickets, especially for those who can least afford it, is a terrible decision. The expected return is massively negative. Why would any rational person do this?
This is where that no one is crazy principle provides so much clarity. We have to look at their unique socioeconomic reality. For someone living paycheck to paycheck, the idea of traditional compounding, saving $50 a month for 40 years to become wealthy, it's often completely unbelievable.
Because they're facing immediate needs.
Immediate needs, systemic barriers, low-income mobility, it just doesn't feel real to them.
So they see the lottery as the only viable path out, however improbable it is.
Precisely. That lottery ticket provides something priceless. A tangible dream of transcending their current financial limitations.
A tangible dream.
It's a moment of hope. It's a conversation with your friends. It's a form of entertainment that costs a tiny amount relative to their disposable income, but it offers this infinite emotional value. That $5 isn't an investment strategy. It's an emotional insurance policy against despair.
It reflects a reality where the traditional paths just feel completely closed off.
They do.
But I have to push back a little here. Surely we can't just excuse a negative expected value decision because it feels good emotionally. Where do we draw the line between empathy and simply accepting bad math?
That's a fair question. And the line is drawn not in excusing the math, but in recognizing the necessity of being reasonable over being strictly rational.
Reasonable over rational.
Yes.
Yeah.
The lottery ticket buyer knows the math is bad. They're not stupid. But for them, the emotional benefit outweighs the mathematical loss in that moment. And we are all making those kinds of trade-offs between math and emotion, just, at different scales.
That brings us to the next crucial idea then, the value of being reasonable over being strictly rational. Academic finance has always idolized the rational actor, right? And this homo economicus, who always makes the perfect optimized choice.
But the sources just emphasize that the moment you apply that standard to a real human being, it completely breaks down. There's a quote that is essential to remember. You're not a spreadsheet. You're a person, a screwed up, emotional person.
I love that.
A strictly rational investor who tries to optimize every single basis point, ignores the fundamental human need for peace of mind, for a stable home life, for not constantly stressing about quarterly portfolio movements.
A truly rational investor ignores the fact that they have coworkers and a family and social obligations and that they need to sleep at night.
Yes. A reasonable approach, on the other hand, accepts all these messy realities. It ensures long-term consistency and, crucially, emotional endurance. Because what good is the mathematically optimal portfolio if it's so stressful that you panic sell at the very first sign of a downturn?
And the famous story of the Nobel laureate Harry Markowitz illustrates this perfectly.
It does. He won the Nobel Prize for creating modern portfolio theory, a model designed to mathematically construct the most optimal, highest performing portfolio given certain constraints.
The peak of rationality.
The absolute peak. Yet, when he invested his own retirement money, he completely ignored his own math.
What did he do instead?
He went with a simple 50-50 split between stocks and bonds. And when someone asked him why, his answer was profound. He said his decision was based purely on minimizing future regret.
Minimizing regret, not maximizing returns.
Exactly. He knew that the mathematically optimal portfolio would likely subject him to a level of volatility that would cause him so much personal distress that he would panic and abandon the plan entirely.
So the goal wasn't maximizing the return, it was maximizing the probability that he would actually stay the course.
That's it. He understood the human equation. He chose the portfolio that would allow him to sleep at night. That reduced volatility, the lower potential for emotional distress, that was the real driver of long-term success for him, not maximizing some theoretical return.
Because consistency, even at a slightly lower rate, beats brilliant but short-lived volatility every single time.
Every time.
It seems like that emotional endurance is really what matters most.
It is the glue that holds compounding together. The sources suggest that finding a genuine affinity for your investments, or loving your investments, as they put it, provides that necessary staying power.
Loving your investment.
Yeah. When markets are crashing all around you, it's that emotional commitment, that belief in the underlying value of what you own that helps you stick with them. That emotional alignment is critical for allowing the process of compounding to work its magic over decades.
Consistency and staying power. Which, okay, that shifts our focus entirely now to the long game.
Right.
So if consistency is the goal, then we have to prioritize endurance over brilliance. The financial priority shifts completely from earning the highest immediate returns to simply enduring long enough, just staying in the game, to let compounding do its often invisible work.
This is that critical distinction we made earlier. Getting wealthy requires a certain element of optimism, right? You have to believe in future growth and take some calculated risks.
But staying wealthy is different.
Retaining wealth, staying wealthy, that hinges on, and I quote, frugality and a healthy dose of paranoia.
Frugality and paranoia. Why paranoia?
Because true money success is, at its core, survival. It's the acknowledgement that the world is inherently chaotic and unpredictable. The most crucial aspect of investing is just avoiding ruin.
Not getting wiped out.
Not getting wiped out. The ability to stick around for a long time, to avoid being forced out by a liquidity crunch or an emotional panic, is what makes the biggest difference to your ultimate financial outcome. If you're wiped out, the compounding stops dead.
And we see these cautionary tales of brilliant people who missed this survival mindset. People like Jesse Livermore, the legendary stock speculator, and Abraham Germansky, the real estate mogul.
Livermore was famously brilliant. He made fortunes in the market, but he lost everything multiple times and ultimately died broke. Why?
Kept going for the home run.
Exactly. He prioritized massive leverage and aggressive bets. He had brilliant insights, but he had zero margin of error. His overconfidence after a success made him believe he was invincible.
He had the talent to get wealthy, but he lacked the humility to stay wealthy.
That's the perfect way to put it. Contrast him with Germansky, who was a successful real estate investor in New York, who tragically lost his mind and disappeared shortly after his highly leveraged assets just plummeted in value.
The core failure for both of them, then, wasn't a lack of talent.
Not at all. It was a lack of caution. They prioritized the rapid accumulation of wealth over the unbreakability of their position. survival maintaining cash reserves, avoiding crushing debt. These are not boring chores. They are the ultimate wealth-building tools that prevent you from being forced to sell during a downturn.
And what makes survival so powerful is the engine that it protects, the compounding engine. This is the financial concept everyone nods along to, but so few of us truly grasp because it works in these counterintuitive, nonlinear ways.
Our brains are just terrible at exponential math. We think linearly. We assume if something doubles in 10 years, it'll triple in 15. But compounding doesn't work like that at all.
So how should we think about it?
It works like the Ice Age analogy presented in our source material, and this is a visualization everyone really needs to hold on to.
Okay, unpack the Ice Age analogy for us, because I think it really illustrates the hidden power of these tiny, consistent inputs.
Okay, so think about the start of an ice age. It doesn't just happen overnight. It starts with a tiny, almost imperceptible input. A slightly cool summer means a small layer of snow fails to melt near the poles.
Just a little bit of leftover snow.
A tiny bit. But that small layer of snow reflects light. This is the albedo effect. Because that small amount of light is reflected back into space, the Earth absorbs slightly less heat the following year, which leads to an even cooler summer, which means a slightly larger layer of snow remains.
It's a feedback loop.
Precisely. That small, consistent input, a cool summer-fueled and exponentially growing result, a massive continental sheet of ice. The outcome is monumental, but the inputs were tiny and largely unnoticed year after year. That is how compounding works.
So it's the small, consistent decision to save $100 this month,
Which allows the growth of the previous $100 to feed on itself, fueling these exponential results decades later that you can barely imagine today.
And Warren Buffett is the human embodiment of this exponential process. The raw numbers, they always just drive this home for me. $84.2 billion of his net worth was accumulated after his 50th birthday.
50.
People constantly try to replicate Buffett's returns, but they miss the real competitive advantage. His success is not solely about getting the absolute highest returns. He hasn't.
But what's his edge?
His real edge is his longevity. He started investing when he was a kid, and he maintained reliable, solid returns sustained uninterrupted for the longest period of time possible. Time is the multiplier. If he'd only started investing at age 35, he'd be financially successful, sure. But he would not be the world-altering figure we know today. Longevity wins.
So, if compounding is the reward, what's the price we have to pay for it? Because we agreed, nothing worthwhile is truly free.
That's the profound lesson from our sources. Everything has a price. Market returns are not a gift. They require payment. And so many investors try desperately to bypass the volatility and the uncertainty, but that volatility is the currency you pay for access to long-term gains. They want the gains without the emotional pain.
And that is impossible. The cost of successful long-term investing must be paid in the currency of volatility, fear, uncertainty, and regret. You have to be willing to endure the emotional pain of watching your portfolio drop 20% without panicking.
The psychological trick here, then, is to reframe that pain. We have to view market volatility or a downturn not as a fine or punishment for making a mistake, but as a necessary, unavoidable fee.
That's the whole game. If you see volatility as a fine, you assume you did something wrong and you immediately pull back, or worse, sell out at the bottom. You interrupt the compounding engine.
But if you see it as a fee,
If you view it as a fee, like the cost of admission to a world-class amusement park, or the required monthly payment for a potential long-term gain, then you realize it's an unavoidable required payment. That psychological shift encourages endurance. It makes you ask, can I afford to pay this month's fee? Instead of, did I make a terrible mistake?
endurance, survival, and paying the fee. It seems like they all rely on one crucial defense mechanism, and that's worshiping room for error.
This is non-negotiable. Benjamin Graham, the father of value investing, he noted that the purpose of the margin of safety is to render the forecast unnecessary.
Render the forecast unnecessary.
We are terrible at predicting the future, especially the timing of future crises. So you have to plan on your plan, not going according to plan.
So why do we rely so heavily on these single optimized forecasts?
Because it feels good. Optimization feels powerful. Building in redundancy feels inefficient and wasteful. But room for error allows you to endure a wide range of potential outcomes. It's the realization that the world is messy.
And what's the biggest point of failure?
The biggest single point of financial failure is a sole reliance on a fixed paycheck to fund an overly stretched short-term life with absolutely no savings to create a buffer. If that paycheck stops, you are instantly forced to liquidate your assets, often at the worst possible time, interrupting compounding and risking total ruin.
So the defensive strategy is key. Maintaining cash reserves, maintaining liquidity, and adopting what our sources call the barbelled mentality.
Yes. The barbell strategy is simple, and it's powerfully defensive.
Yeah.
It advocates for placing, say, 80% of your assets into extremely safe, boring, low-risk things that will definitely survive the short term.
And the other 20%?
And then taking the remaining 20% and placing it into wild, high-risk, high-potential moonshots. You avoid the medium-risk middle entirely.
Why does avoiding the middle matter so much?
Because the medium risk is where you feel just safe enough to get wiped out, but not dangerous enough to be adequately prepared for it. The barbelled mentality makes you paranoid about the short term and optimistic about the long term. That large safe reserve, the cash, the liquidity, is your insurance against the unpredictability of life. If you have that, you will survive the downturns. And if you survive, you win.
That deep focus on survival and endurance, it really raises the ultimate existential question. What is all this frugality and saving and compounding for? If the goal isn't to flash the big cars or the fancy houses, what is the actual point of all this discipline?
The point is independence and autonomy. When we look at the true value money provides, the highest dividend isn't a percentage return, it's a personal return. The ultimate form of wealth is the freedom to choose how to spend your day.
That is a profound reframing. It's not about owning things, it's about owning your time.
Precisely. And extensive research strongly supports this. A strong sense of control over your own life, the ability to wake up in the morning and decide what you will do, is a better predictor of happiness than income or prestige or objective living conditions.
Money's greatest intrinsic value, then, is its power to give you control over your time. And that often gets buried under the pursuit of stuff.
It really does.
Which brings us to the paradox of high income. We often chase these high-paying jobs assuming they'll deliver happiness, but those jobs frequently come with what we call the golden handcuffs, demanding schedules, high stress, travel mandates, and zero flexibility.
The source material addresses this through the author's own experience as an investment banker. He loved the analytical work, he really did, but the schedule was just brutal. And doing something you genuinely enjoy on a schedule you keep control can quickly feel the same as doing something you hate.
And that's that psychological concept of reactance, right?
That's reactance in action, yes.
The feeling you get when someone strips away your autonomy, even if the underlying task is fun.
Yeah. The moment someone else dictates exactly when and where and how you perform a task, your natural craving for autonomy is violated and your satisfaction just plummets. Money, when it's managed correctly, becomes the tool you use to buy back that autonomy. It gives you the leverage to say no to the demanding schedule, or to just walk away when a job becomes toxic.
So if freedom and autonomy are the real goals, then the strategy shifts entirely away from chasing the highest returns and focuses squarely on the savings rate.
This is the second most critical behavioral insight we're covering. Wealth building has very little to do with your income level or your annual investment returns, and nearly everything to do with your savings rate.
I think this is where a lot of high earners fail. They get the huge salary, but because their lifestyle inflates instantly to match that salary, a phenomenon known as lifestyle creep, their savings rate stays at zero.
So their independence remains at zero.
Exactly. They are just as financially trapped as the low-wage worker, dependent entirely on that single massive paycheck.
They're just running harder to stay in the same place. This is why the counterintuitive advice is to save without a specific defined purpose.
Not for a house or a car.
Right. We're usually taught to save for a specific goal, a house down payment, a child's college fund. But saving just to save acts as this universal safeguard against the unexpected, and, most importantly, it creates options and flexibility.
So saving for flexibility is saving for the unknown. It's saving for the ability to pivot when you need to.
Exactly. That unallocated buffer of cash is your greatest competitive advantage in the modern world. In today's hyper-competitive, rapidly changing environment, the advantages tilt so heavily toward adaptability and, most of all, flexibility. Savings provides that.
How so?
Well, it means if a career opportunity arises that requires 6 months of an unpaid apprenticeship, you are financially unconstrained and you can seize it.
Okay.
If your entire industry disappears, you can pivot without panicking.
It's the ultimate defense against the inevitable turbulence of life. The author's personal confession summarizes this beautifully, I think. His primary financial objective wasn't wealth accumulation for the sake of zeros in a bank account.
No, it was independence.
It was independence, allowing him the freedom to choose when to change paths and to maintain a stable, moderate lifestyle free from external control.
That independence is the goal. And it's the thing that allows you to control your life and avoid the traps set by social pressures, which are the single biggest destroyers of savings.
Which brings us squarely to the behavior that directly sabotages independence and just crushes the savings rate. The ego-driven need for visible displays of success. If wealth is what you don't see, then spending is the act of trading away future wealth and flexibility for current, temporary visibility.
And that visibility is almost always sought as this clumsy proxy for respect and admiration. This is the man in the car paradox.
The man in the car paradox. Explain that.
We spend hundreds of thousands of dollars on expensive possessions, a luxury watch, a high-end car, a massive yacht, because we think it will compel other people to admire us and respect us.
But the sources state pretty plainly that that transaction fails every single time.
It fails because of a profound psychological irony. When you drive that $200,000 sports car, the onlooker is not focused on admiring you, the driver.
What are they thinking?
They're thinking, wow, if I owned that car, people would admire me. They use your visible wealth as a benchmark for their own fantasy of receiving respect. The admiration is transferred immediately to the object, bypassing the owner entirely.
So the very item you bought specifically to project success and receive admiration is completely failing at its primary psychological job.
Correct. And while you are trying to impress people who are ultimately indifferent to you, you are simultaneously sacrificing the freedom and independence that the unspent money represented.
The message is painfully clear then.
True respect and admiration are earned through humility, kindness, empathy, and integrity, not through horsepower or square footage.
And we circle right back to the definition of true wealth. If wealth is unspent money, it's the savings, the stocks, the assets that remain hidden, then the moment you spend money on that luxury item, that invisible wealth is instantly made visible and simultaneously destroyed.
It's the visual cost of ego. Spending beyond a certain comfortable level of materialism is often just a reflection of ego approaching income. It's a way to show people that you have, or maybe that you had, money.
The difference between a reliable car and a supercar.
Exactly. Think of the cost difference between an entry-level luxury sedan and an extreme supercar. They both fulfill the function of transportation, but the latter is purchased entirely for signaling. The more you can embrace humility and let go of the relentless need to impress strangers, the higher your savings rate, and therefore, your true wealth will soar.
That trap of comparison feeds directly into the danger of never enough, which seems to ensnare even the most successful people.
That's the psychological trap of the moving goalpost. Happiness, as we know, is often just results minus expectations. So if success simply means constantly raising your expectations, if hitting $1 million just means you instantly need $5 million to feel satisfied, then success becomes perpetually unsatisfying.
And this is what causes people who have functionally won the game to throw it all away.
We have to look at the tragic examples of men like Rajat Gupta, the former CEO of McKinsey, or Bernie Madoff. Gupta already had a net worth well over $100 million.
More than enough.
More than enough for 100 lifetimes. Yet he risked his entire reputation, his freedom, and his fortune through insider trading because he needed more. He needed the edge, the bigger yacht. Madoff built a successful multi-million-dollar business, yet he succumbed to running a massive Ponzi scheme.
They already had millions. They risked what they had and absolutely needed, their reputation, their family relationships, their freedom, for what they demonstrably didn't have and didn't need.
They were unable to define or accept enough, and the lesson for you, the listener, is a harsh but necessary guardrail. There is no reason to risk what you have and need for what you don't have and don't need.
That's it.
Once you have sufficient security and control, the utility you get from additional money falls drastically, but the risk you take for that money increases exponentially. Defining enough is the only protective measure against the insatiable greed trap. It secures the invaluable assets, reputation, and freedom that wealth cannot buy back once they're lost.
This deep dive really brings us back to that core realization. Financial success isn't about complex formulas or market genius. It's about a few core behavioral tenets: discipline, longevity, prudence, and recognizing that freedom and control over your time are the greatest financial returns you can get.
And if we synthesize all this wisdom, the constant theme is that money management has to be personalized and flexible. We have to accept that final uncomfortable truth we touched on earlier. We are all poor forecasters of our future selves.
That's the end of history illusion, isn't it? We think the person we are right now, the person who needs the current job or who has the current values, is permanent. But our goals, our desires, our tolerance for risk, they will change radically over time.
Radically. That rigid financial plan you set at age 30 might be entirely wrong for the person you become at 50.
So what's the advice?
Therefore, the crucial practical advice is to avoid the extreme ends of financial planning. Don't commit to a strategy that is so rigid, either aggressively optimistic or cripplingly frugal, that you can't pivot when your values inevitably change. You need balance.
Balance is key to endurance. A balanced approach to savings, to work life, to time with family. That all enhances that critical staying power we talked about.
It does. And this flexible approach, paired with that necessary room for error we discussed, is the only way to facilitate enduring happiness and allow compounding to work for years or decades, free from the regrets of past, rigid decisions made by a younger, different version of yourself.
Ultimately, the mastery of money psychology isn't about being perfectly rational, according to some textbook.
Not at all. It's about recognizing your individual circumstances, your personal history, your emotional tolerances, your unique goals, and choosing the strategy that best helps you sleep at night. If your plan causes you crippling chronic anxiety, it doesn't matter how high the theoretical return is, it is a bad plan for you. The goal is peace.
So we'll leave you with this final provocative thought to chew on after this deep dive. Thinking about your current expenditures, especially those discretionary purchases, what financial decision are you currently making purely to satisfy your ego, to signal wealth or success to others? And what would you genuinely gain in terms of independence, optionality, and peace of mind by letting that spending go?